it's a year from now, you can't pay all your bills. You're freaking out. Why? What do you think's going on?
Lost a bunch of money in the markets.
But the important thing is for you not to tell them that, for them to generate that answer themselves. That's, I think, where most financial advisors go wrong, is that they say to them, here's why you need this. Here's why I'm recommending this balance. Here's why I'm doing this. And the thing is that then the client doesn't have any ownership over it. So it's really important with your help for the client to be generating these ideas for themselves, to be living in these scenarios, doing this mental time travel, seeing how things might go wrong, and then creating those commitments, again, with your guidance, creating those commitments with you as a team where they have ownership over it.
Welcome to Redefine Retirement with Ryan Wheless, powered by Allied Wealth. This podcast explores how to live a limitless life of abundance in retirement with clarity, purpose, and confidence. Today, I'm joined by Annie Duke, best-selling author, cognitive psychologist, and one of the leading voices on decision-making under uncertainty. Think about this, folks. For those of you who have money in the stock market, when the market goes down, you want to panic and get out and potentially make a bad decision. She's also a former professional poker champion with more than $4 million of winnings. This is an episode you don't want to miss. Welcome to the show, Annie Duke. I know your poker background. We could talk about that for a few minutes, but what did you do before poker and before you became famous in that light?
Before and after, I am a cognitive psychologist, and I have a PhD in cognitive psychology, specializing in judgment and decision making. So then I wrote a bunch of books about it, and then I teach. I taught at Wharton for 7 years.
Oh, wow. I didn't know that about you.
Yeah. I teach direct to student now on a platform called Maven. I'm working on my next book. I'm in the middle of it. And I consult with companies and firms on improving decision making and also answering difficult questions with data, using data. The majority of my work is actually in finance, all the way from early stage venture through options trading. So very, very, very slow capital to very, very fast. And then I also work with a lot of startups that are portfolio companies of the venture firms that I work with. I'm special partner at First Round Capital and another venture fund called Renegade. So, yeah.
Now, when you're working with those funds, are you helping the traders and the people there to manage emotions and manage risk? Are you going that deep? Or are you helping build out algorithms and trading processes? I mean, give me some more background there if you don't mind.
Generally, I'm working in the decision-making space. It's not to do that I don't, but so I have done some modeling before for clients. But the modeling that I'm doing, it really has to do with, as you're thinking about a decision that you might have to make, are there kind of gates, what we might call category decisions that are going to improve performance? So what's a category decision? Let's imagine that you're trying to eat healthier, and one of the things you'd like to do is eat less sugar. Sure. So what most people will do in that situation is that they'll make a commitment. I'd like to eat less sugar. But then every time they're coming up for a meal, they're making a new decision about whether they want to have sugar or not at that meal, right? Is this going to be the one where my office mate is having a birthday and there's cupcakes and I'm going to make an exception here. It's my child's birthday. I'm going to the movies, and you're having to constantly sort of make that decision about it. What does less sugar mean? Am I not having it here? Am I having it here? And it turns out that, we're not very good at kind of taking care of these sort of longer term goals in our future self. We tend to overvalue the present moment, and we are very, very good at kind of rationalizing those decisions. And then all of a sudden you've made an exception 6 times in a week. So a category decision would be, instead of saying, well, I'd like to eat less sugar. So as I think about what I'm ordering on a menu or what I'm buying at the store, I'm going to try to follow that. A category decision would be, I don't need any processed sugar. So now basically what I've done is I've decided for not only this version of me, but all future versions of me that I don't eat processed sugar. So we could think about how you might apply that in the finance world. We could think about like a circle of competence, right? So here would be an obvious one. Let's imagine that you're a value investor with a long hold bias. You probably shouldn't go around trying to trade options, right? And so by saying I'm a value investor with a long hold bias, you've made a category decision about here are the types of things that I'm willing to invest in, and here are the types of things that I'm not. So when I do any kind of modeling, I'm actually looking for those types of gates, right? What are the things that we can put in place that are going to improve performance where we might be making a mistake otherwise? Barring that, the kinds of things that I actually really do is improve decision processes to debias them and reduce the amount of noise, just random variation in the decision, collect more data around the decision points so that we can close feedback loops more cleanly. And then that process actually generates a lot of data where we can go back and actually look at the decision quality. So we're not so tied up with short-term results, and instead we're looking at whether overall the decision quality is good and improving.
Okay. So you're going to resign from wherever you are doing whatever you're doing. I'm going to hire you to come work here at Ally Wealth with us, and we're going to put you in charge of client psychology.
Well, so I actually have worked with a lot of financial advisors trying to help them to understand how do I actually talk to and interact with clients to help them to actually achieve their long-term goals. So one of the problems that we have as decision makers is that we have stated long-term goals, right? So my stated long-term goal might be, I would like to, just going back to the healthiness, I want to maximize my health span. Okay. And I'm not lying when I say that. The problem is that a lot of times the way that we act on a given decision is actually in conflict with that long-term goal, because those things compete, right? Like ice cream's really yummy. So, right. So it's like, it's hard to actually execute on those long-term goals. Now you might say, well, then that person, that's not really their long-term goal, but it's not true. It's that you have to understand that there's a competition between the person you are today, right now, when you're in it, and all the future versions of you. And the future versions of you tend to take a back seat to the things that you want right now, because, and this is true neurologically speaking, future versions of you are more strangers. They're kind of like other people. As opposed to right now, this is me. And we know that because we can do brain imaging, which shows that if I ask you to think about yourself right now, one part of your brain will light up. If I ask you to tell me about another person, like somebody who you've never met, or like someone you pass by in the grocery store or something like that, different areas of your brain are actually going to be activated. But when I ask you to think about Ryan, tell me about yourself in 5 years. Where do you imagine yourself? You start to recruit the same brain areas as if you're thinking about a stranger. So,
interesting.
Right. So it's not so much that you don't actually have those long-term goals for your future self. It's that your future self kind of loses out in the way that people you don't know kind of lose out to people that you do, right? In terms of like, where are you putting your priorities and your energy and your attention? So one of the things that I've done with financial advisors that I consult with, which I've done quite a bit of, is how do you actually help the client to get on board and actually be able to execute on their long-term goals? So let's take a simple example. We know that the people who didn't panic and didn't sell off their portfolio in 2008 ended up doing a lot better. We know that. The problem is that you can tell people that, and when you're in a drawdown, people still want to sell off all they're panicking, right? Like they're overreacting to that situation. It's very hard for them to stay in the market. Even if intellectually they sort of know, like, you should be buying at all cycles. It's hard for them to actually execute on that. right? But we know it costs them a lot of money. And in theory, they can kind of get on board with that, but like in practice, it's actually very hard to get people on board with that. And so I will work with people how do you actually work with your client in order to get them to execute on what is actually in their best interest, given their stated goals, not what you think is in their best interest, right? They have a stated goal. How do you actually get them to act in the best interest that they have stated for themselves?
And how do you do that when in times of difficulty, like when Trump came out talking about the tariffs in late January, early February, the market sold off big time. We had a lady call Annie, I think the last week or two. She's just convinced that the market's going to crash and wants to pull all of her money out of into cash. Like what? Give me some ideas. I mean, what are some things that we could be doing better as advisors to help kind of get further down into the mindset of these individuals in those moments to help guide them better? Because the last thing I want to have somebody do is sell out at a bottom, not get back in the market, miss all the upside, and then the lifestyle they're going to live in retirement looks uniquely different.
That's right.
Than what they could have lived if they'd have managed their behavior better.
Right. And of course, there's path dependency to that, right? So when you get out, now that's money that you can't then reinvest, which then,
that's right.
On average you're going to win to that. So the answer, interestingly enough, is you have to do the work before the moment that the decision is occurring. So what do I mean by that, right? You have to do advance work before tariffs are announced. Before it looks like AI is going to, crash or whatever,
Boom,
right? Like in case AI is a bubble, I'm not saying it is. By the way, that's not financial advice. I'm using that as a hypothetical.
Hey, with NVIDIA's earnings yesterday, it doesn't look like it, by the way.
Yeah. So, but people are worried about bubbles and things like that. And of course, you can only look in retrospect and see that it's very hard to know on the go forward. But, so this is an interesting decision problem that comes up in all sorts of areas, not just in terms of your behavior in financial markets, but we could also think about your behavior toward, what your health choices are, or what your career goals are, or, you're training for a marathon, which is really hard. And who wants to go out and run 16 miles in a day? Like, going to the gym, whatever, is to go back to what I was saying about, look, there's a really big problem because you have this competition between present self and future self. So present Annie is in competition with future Annie. So most of the ways that we can get better behavior have to do with doing what we call some mental time travel. In other words, when I'm in a cold state, meaning I'm not emotional, I'm not freaking out, I'm not panicking, for me to actually imagine the future, this is something that's very uniquely human, is that I can imagine myself 10 years from now. I can imagine myself 5 years from now. I can imagine myself a year from now. And to actually do that, in order to make what we would call pre-commitments to the way that I'm going to act in certain circumstances. So how can we do that? The first thing is we want to say, okay, let's just sort of let me just show you some data, right? And you can show them data, for example, around 2008. You could show them data around the dot-com crash. And you can show them data at other points where there was, a big drawdown in the market. And you can say, okay, let's look at here is the way that someone's return profile would look under different circumstances. So you sort of help them to understand, here are people who sold off, here are people who kept going. And you can say, look at here's sort of, you look 5 years later and this person has this much money and this person has this much money. So can we get on board with the sort of this data, right? So you do that first. Then you say, okay, so I want you to imagine that something happens that causes the market to go down in some way that's significant. And you do this with the client, right? I want you to imagine that. So let's imagine that something happens and the market goes down, whatever, over 5% or 10%. And it's a year later and your portfolio is doing quite poorly in comparison to, say, indexing the market. Yeah, and hopefully, I assume you've explained what that means to your client,
Sure.
right? So we can look at someone who indexed the market and just sort of whatever, but your portfolio is doing really badly. Why do you think that is? Right? So notice they're not in the middle of a crisis at this point. You're just doing a thought experiment with them. So let's just imagine that your portfolio is doing really poorly. Because, why do you think that is? And obviously they're going to say, well, I panicked, and I sold off during this crisis, during whatever the crisis was. And you can show them COVID, you can show them 2008, you can show them, right? Like there's so many of these things that you can show them and say, well, I sold off. Okay. Maybe they say, I decided that I was smarter than all the experts out there and I decided to try to actively trade. Right? So they're going to come up with different answers for why this is, right? Okay, great. Now I want you to imagine that it's a year after a crisis and you've killed it. You're doing way better than other people that you know. Why do you think that is? And then they answer that question. And, probably it's going to be like, well, everybody else was panicking and I didn't, and I held steady. And they'll give you answers to that. So now you've got those two sets of answers. So you say, okay, so this is great. We've got these two answers. So what are you going to commit to here? What do you think you need to commit to here? And likely they're going to commit to, well, I'm going to do some rebalancing, but I'm going to continue to do something that's relatively close to indexing the market. And, with some rebalancing based on pre-committed balance of equities to bonds to cash. Right. Okay, great. So let's commit to that. Fantastic. Now you're going to do something that's really important. This is a very important step. So you get that pre-commitment, you write that down. Great if you have them sign it. Like, we're going to do this. Okay, you're going to sign it. Then you say to them, okay, I want to tell you something. What you're committing to is really unusual and special. This is not a lie because it's true. It's really unusual and special because most people don't do this. When you look at the behavior of retail investors in 2008, if you look at the behavior of retail investors in COVID, what you see is that most of them are selling off. And when you look at the average return for a retail investor compared to what the market actually returned over that period of time, what you see is they're underperforming that. So this is behavior. Most people do not do what you just committed to. So here's the thing. I know that when there's a crisis, it's going to be hard for you to feel like you can stick to this commitment. But the thing you should know is your ability to do so makes you special. It means that you're way better than the average bear because you know not to panic and they don't. Okay. Why is that really important? Every single person on the planet wants to have a positive self-narrative. We all do. We all interpret information. We interpret our lives in a way that advances our self-narrative in a positive way. It's a natural thing to do. If you didn't do it, you'd be really depressed. You'd be sad. Now, the problem is that desire for a positive self-narrative can often cause irrational behavior that's counterproductive to taking care of a future version of you. I'll give you a very simple example. Let's imagine that you believe a conspiracy theory that is not true, but you really believe it. Right? You totally believe it. Obviously, believing things that are patently untrue is going to cause you to make decisions that are going to be losing decisions because the inputs are going to be really bad, right? You believe something that's totally not true, and then you make a decision based on something that's totally not true. Obviously, that decision is going to be bad because the inputs are bad. Now, someone gives you great evidence that the thing you believe is not true. Okay? So you believe that nobody landed on the moon, that it was faked. and someone gives you really good evidence and explains to you like why, like great evidence, or you believe the earth is flat and they give you all the evidence that it's round. Why is it that people still believe the things they do, though? And the reason is that when the facts come in conflict with our identity, because the beliefs that we have form part of our identity, when the facts come in conflict with that, we will rationalize away the facts, because in the moment, it feels horrible to be wrong, particularly when it's something that you've really staked your identity. I mean, if you believe the earth is flat, you're really defining yourself away from the crowd here, right? Like, I'm going to stand out from the crowd with this one. So it's very, very hard to abandon those strongly held beliefs that are very identity forming. It's really hard to do, because then we don't get to have that positive self-narrative, because now we have to be like, whoa, I was wrong. And I made all these decisions based on this belief. And like, I was hanging out with all these people based on this belief. And now, even though you've given me proof, I'm just going to explain away the proof and say that it's the deep state. I don't know, whatever you're going to say, right? Okay, so that's an example of how strongly we want our narrative to be positive. One of the things that makes us feel bad is when we lose money. Okay, so if when we lose money, that's something that makes us feel bad, we now have to overcome that with a way for us to feel good. And the way for us to feel good is to create a different type of tribal identity, which is, I'm of the tribe that recognizes that even though this is really hard, this is what I'm supposed to do. So when I see other people selling off, I understand that I'm special. So now it's much easier for them to withstand sort of that urge, right? To sort of undo these, get rid of these losses and just get them off the books, because they feel special in comparison to other people. So you're using this idea that we all want to define ourselves in a positive way in comparison to other people to get people to behave in their stated self-interest, in furtherance of their stated self-interest for their future, and to overcome that urge in the moment. So if we take it back to like the dessert thing, when I'm at a restaurant and other people are eating dessert, I want to eat dessert just like everybody else does. It's yummy, but I don't order it. So why is it that I don't order it? Because I know it's hard not to order it when other people are ordering dessert. And so I've just changed my mindset that, wow, other people are ordering dessert, I'm not. And that makes me special. Like the church lady on Saturday Night Live a long time ago, right? Like, isn't that special?
Isn't that special?
Isn't that special? So then I get to feel special. And I feel good that I'm not ordering dessert instead of sad. And that's essentially what you're trying to get people to do, is to redefine this piece of their identity as, my identity is that I do hard things and I do things that other people aren't capable of doing.
Okay. So when you're working with advisors to culminate this process, so to speak, is there like some questionnaires or fact finders that you've built that kind of help guide someone to take a client down this path and get them to arrive at this point mentally? Because one of the toughest things we deal with is, when people retire, they think that they've reached the finish line, but you haven't. You got to live the next 30, 40, 50 years in some cases without a paycheck and not run out of money or income in that process. So your timeline is not the speed at which information is coming at you from CNBC on your smartphone, your car, your radio, your TV, social media. Okay. Your timeline is a 30, potentially 40, maybe even 50-year timeline. So what help me out here. Like, how do I get this?
So first of all, you get them to say what their goals are, right? Then you get them to understand in the abstract, right? Here's how markets cycle. Here's different ways that people can be behaving in those cycles. So you can show them people behave X way when the market is going up, people who behave a certain way when the market is going down. Let's look at those different types of behavior and let's see what the outcome is over this period of time. So you have to get them on board with what we would call base rates. right? What happens in situations similar to the ones that you're considering? So what you're trying to do is advance considering contractions, right? Like, so in advance, you're saying, look, contractions happen. We know this historically. Let's look at different types of behavior during contractions. And let's see kind of what the most winning strategy is during those contractions. We can just look at the data. Let's do that together. And then obviously, you can do that for bubbles as well, right? So like, for example, like one thing that happens, I imagine, during bubbles is that if there's a bubbly sector of the market, say right now, like AI, people have the urge to over-concentrate their portfolio into that sector. But we know historically that's a bad idea because historically, we'd like to be diversified. People are sad when the market's going up that they own bonds. It makes them sad because they're calculating, well, if I didn't have this money in bonds, then, and that money were actually in equities, here's what would have happened and blah, blah, blah. And they're sort of experiencing it as this loss compared to
FOMO, right?
Yeah,
Fear
exactly.
of missing out, right?
Right. And so you can show them what happens in up markets when people are actually unbalancing their portfolio. And you can say, look what happens when people move out of bonds and, and then when the contraction occurs, here's how this person performed compared to this person. So you kind of want to show them historically, right? Let's talk about what sort of the right strategy is here. It's just important to get them on board with that. And then once you do that, then you want to do the pre-mortem and the what's called the pre-parade. So the pre-mortem is there was a big contraction and you underperformed the market. Why do you think that happened? And actually have them engage in that exercise with you. And then you can say the market was in an upcycle, and you got killed. Then you got killed when a contraction came. Why do you think that happened? Right, because that would be the right thing to ask, right?
So puts them there mentally in that moment, right?
Right, exactly.
Okay.
And then have them sort of say, okay, that was bad. Then you can say, okay, there was a contraction and your friends actually kind of did really badly, but you did pretty well. You did better than they did. Why do you think that happened? So that's the pre-parade. I did good, right? It was an upcycle and all your friends were crowing about how well they were doing. But then when the market contracted, they were sad and you were happy. Why do you think that happened? So you get them to understand that, right? Now you have them actually generate the pre-commitments with your guidance. It's really important for them to have ownership over it. It's something called endowment. So you want them to generate the pre-commitments. So the pre-commitments could be things like, if there's a contraction and I have a desire to make a decision about pulling money out of the market, I'm not allowed to do so without waiting a few days, talking to my advisor, or you could even say, I'm just not allowed to do it. Right. But they can figure out like, what are the pre-commitments that they want to make? Right. Like, so don't make a decision on the day the market goes down. Like, can we make that pre-commitment? Right. Give it a bit. Maybe you want to make a pre-commitment that no matter what, right? Like under any if it's a retiree, I assume they're going to be in something that's like 60-40, 60, 65, 35 something ish. Right. So, no matter what, that's going to be my balance. And it doesn't matter if we're up, down, whatever. That's what I'm doing because that's my risk appetite. Right. I'm not 20.
Right.
So I don't want to be all equities over here. Right.
Yeah. This is so interesting because we try to manage this with allocation in some cases. And I do allocation differently than Allied Wealth because allocation typically is stocks, bonds, commodities, real estate, international, stuff like that. Right. But, allocation to me is also having money in a risk investment and a safe investment.
Right.
Okay.
Yeah.
And so like we look at things that can be jeopardized in the down market, which is largely security, but that's food, water, shelter, clothing, access to healthcare, medicine, transportation, utilities, right? The things that you must have in place to enjoy any quality of life whatsoever. And when those things are threatened, your spidey senses go up and the emotions rise and we, shut down and oftentimes make bad decisions. So what we try to do is say, listen, we call that non-discretionary expenses. So say you have $70,000 a year in non-discretionary expenses. Well, Annie, how much of that would you like to have guaranteed to you for life? And every single person asked that question to always says all of it. All right. But I'll say, okay, there's a couple ways we can do this. One, your Social Security will be there. Okay. At least 80% of it will. It's debatable in some cases, but at least 80% will, right? If you don't have a pension, we can create one and we can do so by utilizing some type of an income-based annuity. And they automatically, I don't like annuities. I don't want that. I'm like, well, listen, the only game in town to guarantee income for life is an annuity. Okay. And they won't buy the annuity and they'll go put all their money in the market. And it's mind boggling to me because they want this stuff guaranteed for life, yet they don't make the decision to say, you know what? I do want to have this guaranteed. I don't want the stock market to dictate whether I have utilities paid for next month or not. Right. And the disconnect is very, very interesting to me.
That's a good example of, okay, imagine that we make this decision and you don't want to do that. And, I guess the other thing is you could do something that throws off very little income, right? Okay, let's put a whole bunch of money in treasuries. If you want to hold it, if you don't want an annuity and you want to hold it in cash, fine. Right? Like, okay, we'll buy those. But,
right.
But to say, okay, let's imagine that we actually do this allocation and it's next year and you can't cover your expenses. Why do you think that happened? So it's just
That's
getting
really
you to sort of be, and then, okay, what do you want to pre-commit to? And then the other thing I would do is, here's what I think people's reaction to annuities are. It's actually a similar reaction to insurance.
Right. Or life insurance or.
Well, like people have fire insurance on their house are really mad if their house never catches on fire. They're happy if it does, but they're really unhappy if it doesn't. And it's because of, I think that people need to have the concept of a hedge explained to them in very simple terms, which is a hedge is something that protects you or mitigates the effects of the downside, but you have to pay for it. It costs something. And the weird thing about a hedge is that you hope you never have to use it. It's a weird thing about a hedge. So to take it out of the financial markets, I think it's important to explain, like, let's imagine that I have a child and their dream is to get married in an outdoor ceremony. That's their dream. Well, what if it rains? So I have to think about that, right? Like, let's imagine that the day is ruined. Why is it ruined? Well, the weather was bad. I mean, that's very clear if I do that thought experiment. Okay, so maybe we should either pick a venue that has an indoor option, or we could make sure that we have a backup, which would be a tent. But notice that all of those things cost money, right? It's going to be more expensive to have a venue that has an indoor option. It's going to be expensive for me to reserve a tent that I may never use. But if I do the thought experiment, if I allow myself time to time travel onto the day of the wedding, it's clear that I should be willing to pay for that hedge, right? Because I'm trying to mitigate the downside, but it's going to cost me money to do it. Now, inevitably, when it's a beautiful sunny day, I'm like, oh, I was such an idiot to have that tent. But no, you weren't an idiot to have that tent because you don't control the weather. And maybe the weather was going to be bad. So the question then can be reframed, which is, an annuity is going to cost you something, because it is, right? Like the annuity is making money. So it's not throwing off everything, right, to you. So you're giving back a tiny bit, but what are you getting in return? You're getting in return a guarantee that when your house burns down, you're going to be able to rebuild it because you have insurance that costs you money. And the last time I checked, insurance companies are making money. So you're paying a little bit more than what the value of that policy actually is. But that's the exchange, in the same way that when I go to a restaurant, I have to pay money for the wine and they're making a profit on it, right? Like no problem there for me. But
that makes two of us, by the way.
Yeah, right. But so the thing is, like, what if my house burns down? Well, then I want to have insurance. The problem in our head is that we're like, when the house never burns down, then I'm really mad that I ever had insurance. And you'll see actually this type of behavior in areas that are in bad flood zones, where if there hasn't been a flood for a really long time, people cancel their insurance because they're mad that they're paying it. And then all of a sudden there's a flood, and guess what? They're not insured. So when the event is more vivid for them, more recent, like there's just been a bad flood, like I'm sure California just had a bunch of floods, people are probably buying flood insurance left and right. Right, then people will have flood insurance. But then when a bunch of time goes by and California is in a drought, which it often is, then people cancel that flood insurance, even if they're in a floodplain. So where people will get on board with an annuity is when something horrible has just happened to them. But they ought to be imagining that occurring in the future. And then it's, which option do you want? How much do you want to pay for this hedge?
And
we can discuss that.
Annie, is that the mindset changes after the loss occurs.
Right.
And if the mindset would have changed before the loss occurs, you would have had more money overall to put into the annuity and left your other money out there to grow in the markets. And you can afford to take that risk because you have guaranteed income providing your food, water, shelter, clothing, access to healthcare, medicine, transportation, utilities. It's just a very interesting.
That's why this idea of a pre-mortem, imagining the bad thing and living it prior, right? So it's a year from now. You can't pay all your bills. You're freaking out. Why? What do you think's going on?
Lost a bunch of money in the markets.
So, but the important thing is for you not to tell them that, for them to generate that answer themselves. That's, I think, where most financial advisors go wrong, is that they say to them, here's why you need this. Here's why I'm recommending this balance. Here's why I'm doing this. And the thing is that then the client doesn't have any ownership over it. So it's really important with your help for the client to be generating these ideas for themselves, to be living in these scenarios, doing this mental time travel, seeing how things might go wrong, and then creating those commitments, again, with your guidance, creating those commitments with you as a team where they have ownership over it. And then again, that special sauce is, just know your friends are going to crow when the market's in an upcycle, but you're going to know better. You're going to know they're making a mistake that you're not making. And when that down cycle comes, they're all going to be wanting to sell off, and you're not going to do that. And that's going to make you special.
Right.
Because you're doing
powerful.
Something really hard, and you have a secret that they don't have, that you figured out for yourself. And that's like this, it's this huge sort of special thing that kind of goes along with that. And then you let them make the pre-commitments. So that could be, as I said, a pre-commitment to, I've got this percentage of my portfolio here, this percentage here, this percentage here, this percentage here, and all I'm going to do is rebalance. We're just going to rebalance. And that could be what you do, right? It could be, I have to take a breath and wait a week before I make any decision. So when I'm panicking, I have to call Ryan. We're going to talk about it, and I'm going to have a cool down period. So that could be what your pre-commitment is. But you figure out what those are, and you have them generate it themselves. They then own it. And because they have ownership over it, they're actually going to value it much more than if you gave it to them, because they created it. It's their creation. And this again has something to do with something called the endowment effect, which is whether it's material goods or ideas, we value things we own more than identical things that we don't own. So like a simple way to think about that is like, if you've ever gone to sell a car and you look at Edmunds or Kelley Blue Book or whatever, you're always like, well, obviously this should be at the top end because it's my car and it's great.
It's
and then you go to buy a car and you're like, this is outrageous. They're asking for the top end. I should be getting it at the lower end. This is for two identical cars. So people just like their own ideas better than they like identical ideas generated by somebody else. So you want them to have that extra value to these commitments. And to get that, you really want them to have ownership over it. And so they have to have generated it.
Really interesting. Going back to the insurance thing, you mentioned the fire insurance, right? To me, the guaranteed income for life, I'm a big fan of that, if you can't tell, by the way.
Yeah, no, it's insurance.
Sure. But the thing is you're insuring against market crashes or having too much exposure to market risk and losing so much money to where you can no longer afford to stay retired or enjoy the same lifestyle that you earned, right? But what's wild to me, Annie, is I can't predict the future, but I can guarantee you this: the market's going to go up, it's going to go sideways, and it's going to go down. It can't do any more than those three things. And I can tell you this: you're going to see, you're retiring at 60 today, you're likely going to see 4, potentially 5 downturns of 35 to 40%, somewhere in that range during retirement. Not one time. You could see it as many as 4 or 5 times. So we know it's coming. Right. I don't know if my house is going to burn down, but I know those pullbacks, those downturns are coming. It is the nature of the market. It's the way it works.
Right. So that goes back to the idea of kind of like base rates, right? So you can show someone historic data on market cycles. And you can tell them, here are the base rates, right? Look, this is how many times you see this is what the market cycle looks like. This is how many times you see a downturn. This is how many times you see a bubble. This is how many times it just whatever. You can also show them this base rate. On average, what percentage of the years historically does the market end up compared to the previous year, where it ended at the previous year? So you can show them that. Depending on what data you're pulling, it's like 70-ish, 75%-ish. You can say on average, if you average out all of these years, how much does the market go up per year? Right? So that's different, right? That's just an average. So, we know on average the market goes up, but it goes up like this, right? Like, I guess it goes up like this. Okay. So you can show them all of that. And what you can say is there's no reason for you to expect that things are different in the future. So having shown them that, right? Because we can talk about .com crash, 2008, COVID, tariffs. That's 4 right there. Right? So, you can show them that data and you can say, the one thing that's true is things stay the same. This is the nature of the beast because it's human beings participating in a market. So let's now imagine we're in a drawdown because it's going to happen. I'm showing you this. I want you to imagine that. And that's what helps them to then generate those ideas.
Very interesting stuff. Fascinating stuff here. I don't even know what to say. Your work here is incredible. I mean, this is exactly what I need to be teaching my team and other advisors need to be learning because, man, I have a guy, a perfect example, during COVID. He had a bunch of Exxon stock and then he was an anti-annuity guy. The rest of his money was in markets, reasonably aggressive. Said he wanted 20% returns, tested risk tolerance wise for it. I was like, this is nuts, but you've tested for this. This is your, I don't advise you do this. And I will never forget in mid-March when the market was down, like literally the day the market was down 37%, this guy called me with his wife on the phone, screaming into the phone to get him out of the markets. And I'm like, please don't do this. Ryan, I know the world's coming to an end. We're going to be living in shelters here really soon. And I'm going to try to save as much as I've got left. And I'm like, please do not do this. And he demanded, I said, I want you to send me an email. So I've got this in writing. Once I receive the email, I will execute this trade because this is, after all, your money. And I'm strongly advising you to not do this. His wife is screaming into the phone, please don't do this. Well, we did. Guy never got back in the market. Money's still sitting in a money market account to this day. And if you look at where the market has come from, the base level with COVID, I mean, good Lord, we are, but the thing is the guy's never gained his confidence back. His retirement lifestyle looks uniquely different than it should have in a big way. Quite frankly, he should have never taken that risk in the first place. But, I can only guide, right? I can't make someone do something. I can guide you and tell you what you should be doing based on my advice. And ultimately, the lifestyle he lives today is not the lifestyle that he earned in a 35-year career working in a miserable company. So imagine
if you had him do this exercise, right? I mean, think about how different that looks.
For sure. I'm thinking, yeah.
So, first of all, he wouldn't have an expectation of a 20% return. Let me just start with that because that's not what the market returns per year, right? But separate from that kind of, that was the one that made me go, whoa, that's way bigger than what you should expect. And you're going to have to take on a lot of risks to do that. If you had said, okay, let's imagine that there's a drawdown, right? Let's imagine that the market goes down 37%. Why? How do you think you're going to perform? What do you think you should do under those circumstances? And you have them generate all that for themselves. So I'll tell you just my own story. During COVID, I got asked by a lot of people. I was getting calls from people in finance asking me sort of my advice, and they said to me, well, what are you doing? And I said, nothing. And they said, well, how's your portfolio doing? I said, I have no idea. And I was being totally honest. They were like, what? And I was like, well, I mean, at the time, I still do. I think I have a 70-30 balance. I mean, I have money in other places too, but in terms of stocks versus bonds. And the person who handles my money I tell them just rebalance it. That's it. They were like, what? You don't even know how it's doing? I'm like, no, why would I look at it? I already committed. So like legit, I didn't even look at it because the decision that I was making was a long-term decision. And what's happening day to day matters very little. There's a chart that I really love, which you can steal from me if you want it. So it's a chart of Berkshire Hathaway stock. And it's looking at Berkshire Hathaway stock from inception to today. And today in this case was 2018. So it's looking at that. Now, when you're looking from, 1960 to 2018, it looks like a relatively straight line up, right? That's what it looks like. But I show a close-up of a random Tuesday at 11:30 in the morning. It's like a straight line. It's like, bruh, it just dropped. Because the thing is that while when you pull out, it looks kind of like a straight line up. When you actually zoom in, there's a lot of down days in there. So how's it going to help me to be watching it every second? So people talk about it who are like active traders, but it's a term that we used in poker as well, which is called ticker watching. And when you're sitting there watching the ticker, you make a lot of stupid decisions because you lose sight of what the long-term trends are. And you get really caught up in the fact that something bad is happening right now. I host a podcast, the Decision Education podcast, and we had Howard Marks on. And he said the one thing you can always count on in the market is overreaction. And it's true. He's right.
It's very true.
Right?
Very true.
And so if you're looking at Berkshire Hathaway on that random Tuesday at 11:30 a.m., you will overreact to it. And God forbid that you sell, because you know what it did after that? It just went up, but it goes up like this. So you have to commit to not ticker watching. You have to commit to, there are market cycles and you can't time them. That's an important thing. Can't time them. You can only see the cycles in retrospect. You know, what I tell people all the time is, I know the market will go down at some point. I just don't know when.
Right.
Like, I can tell you it will happen, but I have no idea when. Right. It will happen though. Just like you're saying, look, if there might be 4 down cycles during your retirement, can you tell the date those are going to happen? Absolutely not. You just know they are. You know they're going to be there. So pulling people out to this kind of longer term view and saying, here's kind of what it looks like in general. Let's commit to maximizing based on that, which means maybe one of the commitments they make is they don't look at their portfolio day to day. Maybe they look once a quarter to see how it's doing. That, by the way, is one of my pre-commitments, is I don't look at it every single day. I look at it once a quarter. And that's really helpful because I know what happens every single day matters very little in terms of what my goals are and my commitments are. So you get them to generate these things for themselves, and it is absolutely life-changing.
Really, really interesting. And it's what I see is once somebody steps out of that job and that paycheck stops coming in, about a year into it, the emotional ties they have with that money, that pot of funds they're using to live the next 30 or 40 years without that paycheck, just goes to the roof. Even people that think they can deal with it, they can't, because you're losing your security. In your mind, you think you failed, you made bad decisions. Oh my God, what did I do? Right. But I really like this idea of going, hey, Jim, a year into retirement, here's what happens. How are we going to deal with this?
Right.
I like that a lot. That really frames that in a way. One of the things
that you can do is say, this is actually a really good one. If you're worried about that type of thing, you can say, okay, it was a year in and you panicked and you made bad decisions. Looking back from that, you realize there were early signals that was going to happen. What were they? This is actually a really good exercise, because I'm sure that when you start to see that behavior, you see signals that this is starting and it's going to happen.
Oh, for sure.
Right. So you say to them, look, okay, so you made this terrible decision, right? Like whatever it is. Looking back, you realized, there were early signals that I was heading in that direction, that I was heading toward that type of panic or that type of poor decision-making. What were those early signals? Okay, great. Let's write those down, because you just generated some great ones. Let's write those down. So for any of those signals, what are you going to do when you see them? And this is such a good thing. So it's based on something, which is, I call it kill criteria, but I'm on a certain path and I'm heading down a path. How do I stop myself from heading down that more quickly? And I want to make sure that I have some sort of criteria in place that will make me stop. Okay, so here's a very simple example of that. When people are climbing Mount Everest, they have something called a turnaround time. And the turnaround time is on summit day, no matter where you are on the mountain, if it's 1:30 p.m., you have to turn around. Just don't summit. Now, not everybody follows that. Some people still continue up the mountain, mostly to pretty bad results. But you know what? More people turn around because they have that in place. So it's a very simple example of a kill criteria. Stop loss would be one of those. But you can have more complex ones. So when I'm working with traders, for example, they don't have stop losses. That wouldn't make any sense. But what we do is we say, okay, what's your thesis? Why are you putting this risk on? All right, here's your thesis. All right, the trade has gone really bad. Looking back, what do you think the early signals were that told you that the trade was going to go poorly? And it always has to do with their thesis, right? So, for example, if they're making a bet on interest rates, it's always like, well, the Fed started sort of signaling that interest rates were maybe going to go against my thesis. I ignored it. and I stayed in the trade. Okay. So how strong does the Fed signal have to be for you to decide to get off the trade? And then they write that down. With one of my long short investors, that's
a tough road to hoe, by the way.
Well, true, but people do it if you ask them to do it. With my I have an investor who's a value investor, and we have bands around earnings reports. So basically, as long as the earnings report is within this certain band, you're literally not going to do anything. And if it falls below the band, we have a plan in place. And if it goes above the band, we have a different plan in place. So you have no reaction as long as it's within you've already decided what the band is, right? So it's not about, because generally the projections for earnings are a point estimate, but a point estimate isn't very helpful, right? You want to know sort of within what's my tolerance for below and above, and decide that in advance. And then if it's below or above, you've already decided what your reaction is going to be. So you can do that in this type of situation too. Things have gone poorly. Looking back, there were early signals that I was heading toward that type of reaction. What were they? When I see those signals, what am I going to do about it?
Wow. Well, Andy, this has been fascinating. I didn't know what to expect having you on today, and I got way more out of this than I thought I would. So I can't thank you enough. I really did.
I'm happy you were pleasantly surprised.
Yeah. I just, the cognitive part of this, and I didn't know that you work with financial advisors prior to having you on. So I would love to have you back on some more in the future.
Yeah, absolutely. Yeah.
Before we go, I got to ask something about poker. I don't know what.
Okay.
What was, give me a defining moment for you at the poker table? Like, were you staring somebody down? Give me,
Yeah. So I'll tell you, I think there were two defining moments, and I think it actually has to do with this conversation. So the defining moment number one was, sort of realizing that one of the best decisions that I ever made in poker was just folding my hand. And I think that it's surprising to people because you think it's like the big bluffs where you like won a really big hand. But you have to have this mindset shift. And I think it speaks to what we've been talking about, where you realize, to your point of now that person didn't have more money to invest later, that choosing to continue in a hand or choosing to fold in a hand is actually an equally important decision. Because if I continue in a hand that I ought not to be continuing in, what that means is that the money that I'm investing further in that hand, I'm going to be investing at a loss. And then that's money that I can't invest in the future in really good hands. And if I fold in a situation where I should be folding, then that's really good because I'm preserving that capital to be able to turn through the game in a better spot. So I was playing in the Tournament of Champions. It was a $2 million winner take all. They invited the 10 best poker players in the world to come play. And somebody raised in front of me and I re-raised them with 2 10s. And then another player moved in. And it was an interesting situation because there was 3 times as much money in the pot as I had to call, which means I only actually have to win this pot 25% of the time to make this a reasonable continuation for me. And I really thought about it. And the person actually had a little bit of a tell, back to the beginning of the conversation. And I just realized that they either had aces or kings or ace king. And I wanted to decide between them because it really mattered to the math. And after I saw the tell, I realized that they couldn't possibly have ace king. So they had to have aces or kings. And if they had aces or kings against my 2 10s, even getting 3-1, that's a very bad situation for me because I'm only 18.5% to win. So I folded. Phil Hellmuth stands up and yells, "This is the worst fold I've ever seen. You were getting 3-1 from the pot." So this was right before a break. I went off. I came back, eventually knocked that player out who was the one I folded to. As I knocked him out, he comes around to me and he whispers in my ear, "I had kings."
Wow.
And I went on to win that tournament against Phil Hellmuth, actually, by the way. That's who we got. So I think that was a really important moment for me to realize that sometimes it's the things that you don't do, right? Like that I didn't continue in that hand when I think most people would have, that allowed me to preserve my capital to be able to actually win that tournament. And then there was another hand that was really defining for me, again, just in terms of mindset shift. So when the poker boom happened, I was actually pregnant with my fourth child. So I missed the first 6 months of the poker boom. This is important because there were a lot more novices that were playing in these sort of big money situations. And so my kind of model of the way that a poker player behaved was off at that point, because I hadn't been playing with this kind of flood of novices in the game. So I'm playing a pretty big tournament at Foxwoods, which is in Connecticut. And a guy raises and I call with a king queen. I raised with king queen. And this person called in what's called the big blind. Okay. So the board came an ace and a 10. And the person bet and I called, planning to sort of what's called a semi-bluff the next round. The next card was a nothing. And I remember I have king queen. So with the ace 10 on the board, I really need a jack if the person has an ace. If the person doesn't have an ace, I could hit a jack, a queen, or a king maybe, but I sort of know I'm kind of bluffing with a way to win in case I'm wrong. So on the next round, the person bets, and because they had sort of let out betting into somebody who had raised, I thought that they had a very weak ace, which means an ace with a very bad card with it, because the board's ace 10 something. So I think the person probably has something like an ace 6 or something like that, and that their hand is weak. So I raised them thinking, my experience with players is in that situation, when you make that type of play, if they have a kind of a weak ace, they're probably going to fold there. Because it's not a particularly strong hand in this situation, particularly against someone who's played the hand the way that I do. So I raised because I thought he had a weak ace. And he called me. Oops. And I was like, oh no, he must have a much stronger hand than I thought. Well, don't you know it? The last card was a jack, which gave me the best hand possible. And he checked, and I bet, and he, it was all his chips left, and he called. And I turned over my king queen. He was very upset, and he turned over a bad ace, just like what I thought he had. But I was very surprised that he was willing to call in that situation. And what I realized is, well, but he didn't know that was a bad hand. That was the problem, because he was new and he was an experienced player. And I was sort of attributing to him knowledge that he didn't possess. So even though I knew what his hand was, that he had a weak ace, what I thought he was going to do with it was really wrong. And what was really important about that to me was this understanding that no matter what you're doing, sometimes there are these dislocations where things have sort of been the same for a long time, and then all of a sudden they're different. And that you need to be aware of that, and you need to be open to the idea that things are different. And I realized I should have figured that out beforehand, because I knew that poker was on television at that point. I knew I had missed the first 6 months of it. And I knew that a tournament that normally would have 300 people in it had 2,000 people in it. So do I think the 1,700 extra people are experts? No, it was ridiculous of me to think that. So given that I knew all the really good players in the world at that point, the fact that this was an unknown person to me who was playing in a big money tournament when poker just exploded all over TV, I should have treated them much more like they were going to be different than the average player. And that was a really high risk play, not against someone who knew what they were doing, but certainly against someone who didn't. And it really changed the way that I kind of thought about what I was doing and how I approached the game.
Wow.
I hope that wasn't too jargony and
It
technical.
was awesome. That was great. It's exactly what I was looking for. Do you still play actively today? And are you still
I
very
retired
involved?
in 2012 and I literally don't play.
You don't play at all?
No,
Wow.
Not for anything, not for fun, not in my house. It's like green eggs and ham. No.
That's awesome.
I will not eat green eggs and ham.
You made a commitment to yourself.
I did.
I'm not going to eat sugar.
It was actually really funny. The other day, so I have a friend of mine who's a fabulous cognitive psychologist named Katie Milkman. She has a wonderful book called How to Change, which actually talks a lot about these types of pre-commitment contracts. I would recommend it to you and your audience. It's a wonderful book about how to sort of change your behavior in a better way, so that you can change for the good. So anyway, she used to be a really, really good tennis player. She played tennis for Princeton and she was amazing. And I play tennis and I needed a sub for my team. And I just reached out to her and I was like, look, I don't know Katie, but maybe you would come and sub a match for me. And she said to me, after she played in college, she made a commitment because she uses these commitment devices. She made a commitment that she wasn't going to play a competitive match anymore because when she was in college, she realized that she didn't enjoy the competitive part of it. And so she just didn't want to do it ever again in her life competitively. So she was sadly saying no to me. And at first I was like, oh, that's really weird. And then I realized, well, wait, I did that too. I retired from poker and then I have no interest in competing again because I didn't enjoy it anymore. And I was like, wait, I shouldn't think that's so weird that she did that because I did the exact same thing.
That's awesome. Well, Andy, I can't thank you enough. Unfortunately, we're out of time. I could keep going with you all afternoon. I've really enjoyed this. So I want to just thank you. I feel like we've gotten a lot of information that people can use to enrich their lives in retirement, help guide them to make better decisions as advisors and help people just live the best life they can with the resources they have in their golden years, which is the whole impetus behind why we do this podcast. So I really do appreciate it.
Awesome.
Well, folks, that'll do it for today. Thanks again, Andy Dukes, and we'll be in touch with you for sure. I'd love to have you back on to talk more about this stuff.
Absolutely.